We are live on Zoom as well. All right, we are live on Zoom as well and on the Vantage app. I'm just adjusting my screen a little bit. So just making sure everything is right. I think this does look better. All right, I'm just adjusting the screen settings. So it's displayed. Oops. Okay, I think now this is better. Right. Okay, good. We've got everything lined up perfectly well. All right. Okay, so we're streaming in directly into the Vantage app as well as on Zoom. All right. So do drop your questions in the relevant chat boxes, and I'll be more than happy to go through any queries that you may have. All right. Okay. Okay. Hi, everyone. Welcome to today's webinar session brought to you by Vantage Markets, where we'll be covering trading trends, what's moving the markets. All right. Okay. We're good to go. So as we mentioned earlier, Peggy. I'm taking over Peggy today. She's feeling a little bit under the weather, and we're streaming directly to the Vantage app as well as over Zoom. All right, before we start, here's a quick disclaimer. I do take note that the information, context, and opinions which are expressed in this presentation and on the following slides are solely those of the presenter and not necessarily those of Vantage, and are solely used for educational purposes as they do not constitute investment, advice, and/or consultation on how a client should trade. Also, do take note that of the risk warning that comes with trading margin, FX, and CFDs. They carry significant risk and is not suitable for all investors. You could substantially lose more than your initial investment. All right, so my name is Ketan Ramachandra, and I'm an investment analyst here at Everest Fortune Group. So this webinar series is brought to you in a special partnership between Vantage Markets and Everest Fortune Group, where we have been finalists for Best FX and Equity Research for the following years, 2019, 2020, and 2021. All right. So since the topic is on trading trends, so what's been in the news recently? So we've had Jolt's job openings data, which came out last night in the US, which has also acted as a catalyst for the dollar index. We've also had a suspected intervention by the Bank of Japan in the currency markets. We'll go look into more in that and how that impacts the yen crosses as well as dollar yen. We've also had the Reserve Bank of New Zealand releasing its latest cash rate statement earlier this morning. And we have the last two bits of labor data for the US, two important bits of labor data. We have the ADP employment report coming up later today, as well as the much awaited non-farm payrolls coming up this Friday. All right, so before we start, we're going to look at what has moved the markets recently, which has been the JOLTS job openings, the suspected BOJ intervention, and the RBNZ cash rate statement as well. Right, we'll start off with these three, and then we'll move on into into the ADP and NFP reports, and then we'll do a quick analysis on the majors as well. All right, okay. So with regards to JOLTS job openings, right, as you can see here, the forecast was for, okay, so JOLTS job openings, for those who may not be familiar with this is a metric that tracks the number of vacancies that are available in the US labor market. So if this number is trending higher, that means companies and corporates in US are looking to expand their labor force. So that means they are looking to they have higher hiring intentions, right? They have more intention to hire more employees. And if you have dwindling job openings, that means companies are not looking to hire aggressively, and we could see a potential softening or a slowdown in the labor market. So that's how we can simply interpret JOLTS job openings. So as we can see for the month of August, which was the recent data that was released overnight, the forecast was for 8.1 million openings. but we had a much higher reading of 9.61 million. So we had 9.61 million job openings versus the expectations of 8.8 million. So generally, when you have a much higher than expected number, this usually acts as a very bullish, or not very bullish, I should say, this usually acts as a potential bullish catalyst for the dollar index, right? So it acts as a potential bullish catalyst for the US dollar. So the US dollar goes up. Then, of course, that means dollar index also goes up and all the other major currency pairs will react accordingly. And not only that, we had the previous number, which was July's reading, which was revised up. This number was revised up from, I think it was about 8.3 billion. I think, if I'm not mistaken, it was revised up from 8.3. It was revised from 8.3 up to 8.92 billion. So we had an upward revision in July's data, which is also bullish, which also signals as a bullish catalyst. And we also had August, the reading for August coming in at 9.6 million, which was much higher than the forecast of 8.1. So we had two data points that have contributed to a bullish reading. So this data was released at 2 p.m. GMT time. So if we go back into TradingView and we go look on the chart for the dollar index, which we see here. So 2 p.m. GMT, you could see it's a very volatile spike, very, very big spike. Dollar index opened at 107, roughly dropping as low as 106.90 before spiking as high as 107.35, right? So we had like a almost 40 pip, 45 pip range within this when this piece of data was released. So you can see that it did have a very impactful it did have a major impact on the dollar index, but after that, it just consolidated around 107 level, right? So we can see that such data points can have a major impact on the direction of the US dollar, which would of course impact the dollar index and hence all the other major currency pairs. Right, so this data was bullish, so that's why we could see the spike going up as high as expected, and then prices just consolidated around 107 before now. Before today, prices have broken under 107 today, right? So after a very strong run up in the dollar index, we can see since opening on Monday, 2nd of October, the dollar index has gone from about 106.30 to as high as 107.30, right? Gaining almost 100 pips in the process. So any pullback is quite likely to happen as well. It could be a combination of profit taking or running into major resistance levels as well, right? So that's how we can see how the JOLTS data has impacted uh, the dollar index. Right. Okay. Then going back to the slides, we had we had a suspected intervention by the Bank of Japan. So what do we mean by this intervention? All right. If for those who may remember last year around October or November, when dollar yen hit about 152, the Bank of Japan at that time had intervened in the open currency markets once again. So now what do we mean by this intervention? Right, because when dollar yen hits levels such as 150, 152, it means that the Japanese yen has weakened very significantly. So that means that Japan's imports become much more expensive, right? If your currency is weakening significantly versus the US dollar, that means any potential imports coming into the country are going to be significantly higher as well. So in order to stem the devaluation of the Japanese yen, the Bank of Japan intervenes in the open market time to time, and it did that last October as well. They did it over a period of 3 to 4 months, from October till January of this year. So when they intervene in the open market, this is what they do, right? Because the Bank of Japan is one of the largest holders of US treasuries as well as US dollar. So when they want to intervene in the open market and they want to strengthen the value of the Japanese yen, they will sell the US treasuries and they will also sell the US dollar. And the sales proceeds will then be used to buy up the Japanese yen in the open market. So when this happens, we can see currency pairs such as the dollar yen and all the other yen crosses falling quite significantly, which is what happened last year as well. So if we look at the charts of dollar yen last year, let's go to TradingView. right? Let's go into the weekly chart so we can appreciate this much more. So as you can see here, back in September, this is sorry, DXY. Let's go to dollar yen. So we can see back in mid-October, dollar yen went as high as 151.90. And then shortly after, the Bank of Japan started intervening in the open market, in the open currency markets. So when they do that, as I mentioned, they started selling the US dollar, they started selling US treasuries, and the sales proceeds were then used to buy up the Japanese yen in the open market, which causes currency pairs such as the dollar yen to fall. So as you can see, dollar yen fell from 152 basically to as low as 127 by mid-January. So over a space of 3 months, 3 to 4 months, we saw the dollar yen fall rapidly. Similarly, we would I think also see it in Aussie yen as well, I think. October, yes, you can see Aussie yen going as high as 98.44, although the pullback was not as much as expected, but generally the yen crosses did pull back as well. But it's more prominent in the US in for the dollar yen because the Bank of Japan was specifically selling US treasuries and the US dollar uh to fund their purchase of the Japanese yen in the open market. So when they do that, dollar yen is going to fall. So what happened yesterday was another potential intervention by the Bank of Japan, which they have so far denied that taken place because when the Bank of Japan intervenes, they will not like to make any announcements because, and if it's a pre-planned intervention or if it's pre-scheduled intervention, it does not have the same impact as it would. So we can see clearly here, dollar yen went as high as 150.15 to fall as 147.37. So it dropped almost 2% or nearly 300 pips within minutes, right? So if we go on to the lower time frame, let's go on to the 5-minute time frame where we can appreciate this a lot more. So we can see here, this is 14:05, this is 2:05 p.m. GMT, and then at 2:10 GMT time, 14:10, this is when the intervention took place. So price basically created going from 150 to as low as 147.30. So price dropped about 270 pips within 5 minutes. So you can see how strong of an impact an intervention measure like this can happen. So naturally, moving forward, the Bank of Japan may continue to intervene in the currency markets. And of course, this will be unannounced as well, because this would then have a major impact on currency markets, right? When you have unannounced intervention measures by a central bank, that's when you can have the greatest impact, which is what they intend to do. So that is why we saw the dollar yen lose 2% yesterday overnight, falling almost 300 pips within 5 minutes. And once all that had taken place and the noise, the intervention had stopped, basically they just made a one big bulk purchase. Pretty much, it seems like they made one big block purchase of the Japanese yen in the open market. And then once prices stabilize, we can see the dollar yen bounce higher again. So this is when the market forces have now come back into play, where demand for the US dollar is still relatively strong. That is why we are seeing dollar yen rise up shortly. So we can see dollar yen falling rapidly here, sorry, because of an intervention measure. And then after that, we are letting market forces take over. Right. Okay. So if we look at the 4-hour chart here, you can see how strongly the dollar yen has risen for most parts of this year. And when we go back, back as October, you can see the pullback as well, how significant the pullback was when the intervention was taking place. Now, whether the Bank of Japan is going to continue to intervene in the open market over the next few weeks or few months, we will wait. Well, we're not sure when they will do it because it'll be unannounced, but it's quite likely we can expect them to intervene in the open market in the next few weeks or soon after. All right. Okay. So that's what happened to dollar yen overnight. Next, we had the Reserve Bank of New Zealand announcing their cash rate statement, right? So they have kept the official cash rate at 5.5%. This is the third time in a row that they've kept their cash rate on hold. Partly the reason is because they find that the board has judged that the higher interest rates have led to monetary conditions that are restricting spending and reducing cost pressures. And although inflation remained too high, they feel that they do not need to raise rates anymore, and the impact of keeping rates at 5.5% should have the desired effect to allow inflation to return to their range of 1 to 3% annually. However, they do see risk of higher oil prices, which could potentially create short-term spikes in inflation. But however, the main concern for New Zealand is being a very export-oriented country, and especially with one of their biggest importers being China, there's significantly weaker global demand, and especially from China, which is weighing on their export revenue. So when you have New Zealand, whose economy derives very much on exporting its resources, and when you have global demand weakening, that means there's less demand for the Kiwi dollar, which is why we saw the Kiwi fall quite significantly following the release of this cash rate statement. So now if we look at the chart for the Kiwi dollar, right? So this news was announced today at, was it 1 a.m.? When was this released? Hang on. Sorry. This was released at 1 a.m. GMT time today. So you can see the Kiwi dollar was trading about 559.20, and then it swiftly dropped as low as 59. So it dropped about, so it dropped 58.70. So it dropped about 50 pips following the release of the cash rate statement, but then it stabilized around 58.90 and it's sort of consolidating between 58.90 and 5900 as we speak. Right, so you can see that how the effect of holding rates and having a somewhat dovish out statement caused the Kiwi dollar to fall quite sharply following the cash rate announcement. Right, next we have ADP employment report. So that's coming up later today. Right, so if you look at Forex Factory, right, let's go to Forex Factory. For those who may not be familiar, Forex Factory has a very good economic calendar that we can use, right? So I'm going to set my time to GMT time. So it's easier for everyone to reference this. Doesn't matter which time zone you're in. Right, GMT time or UTC time. Right, so we can see here today, we have ADP employment report coming up at 12:15 p.m. GMT time. Right, so last month's number came in at 177,000, and we have the forecast for this month's number coming in 154,000. Right, so as you can see, the employment change has been pretty steady up to July, but August, the reading for August was one of the lowest readings in the last 5 months, right? So job growth does seem to be slowing down as we reach this stage of the business cycle. So as you can see, although the reading of 177,000 from the month of August was okay, it not only it was the lowest reading in 5 months, it also missed market expectations, right? So this would cause, when you have the number missing the market expectations, this generally acts as a bearish catalyst for the dollar index. So generally, if the same were to happen again today, we could potentially see the dollar index fall, and that would mean we would see currencies such as the euro and the pound rise. We would see dollar yen fall, and so on and so forth. And also, we could potentially see gold prices being supported as well. The other thing to take note of, although the reading for August was the lowest in 5 months and it missed market expectations, the July's reading was actually revised upwards. So this generally acts as a bullish signal, bullish indicator for the dollar index. So this was somewhat of a mixed result last month. So let's see how this month's number plays out. So we have a forecast of about 154,000. So do take note, any number that's higher than 154,000 is going to potentially act as a bullish catalyst for the dollar index. And any number that's of course going to be lower than 154,000 is going to potentially act as a bearish catalyst for the dollar index. So do take note of that. So that's coming up today at 12:15 p.m. GMT time. And on Friday, we have the much anticipated non-farm payrolls coming up. Right. So as you can see, non-farm payrolls since June have been relatively lower, right? They've been trending lower since June and it's starting to pick up a little bit. June, July, August, we've seen a slight improvement in non-farm payroll numbers. So we can see that uh, although the August number for August came in higher than the forecast, we saw July's number being revised lower, so that's not good. When you see downward revision, then that should usually indicates that the labor market is somewhat starting to slow down, and that could potentially act as a bearish catalyst for the US dollar. And this was the third, not only that, this was the third consecutive month when job gains are falling below the $200 threshold, right? As we see here, the 200,000 threshold is here. So this was the third consecutive month. And for the forecast for September, points to 171,000. So this means we have a potentially fourth consecutive month of NFPs coming in under the 200K threshold, which means that labor market conditions are starting to ease. So this could potentially act as a bearish catalyst for the dollar index come Friday as well. So any number that prints below 171,000 on Friday is definitely going to act as a bearish catalyst for the dollar index. And of course, conversely, if the number comes in higher than 171,000, this could potentially act as a bullish catalyst. All right, let's go into the charts and try and identify now where are the major resistance and support levels for the dollar index. We'll do that on the 4-hour time frame. Right, okay. Before that, if you look at the daily time frame, dollar or weekly time frame, you can see the dollar index has had a very strong run up since mid of July. I believe we're in the 11th or 12th consecutive week of gains. Let's see, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. Yep, we're in the 12th consecutive week of strong gains in the dollar index is broken through the previous swing high resistance at 104.25. Then it proceeded to break the swing high resistance at 105.40 as well. And now it's going to look like it's attempting to reach 107.90 as well. Right. So price is currently trading about 106.90. Let's see, it has to break 107 first. But yeah, we've had very, very strong gains for the dollar index over the last 12 weeks. And actually, the euro has been tumbling. The pound also has been tumbling. Dollar yen has been rising higher expected. Dollar franc also has been rising very strongly. Dollar cat too, it's been a little bit mixed, but it's also, you can see the general trend has been up over the last 12 weeks. Aussie dollar, no surprises, falling. Kiwi dollar also falling over the last 12 weeks. And of course, gold prices, although pretty choppy, but have been in a general downtrend as well. So you can see how the direction or the strength of the dollar index can impact the other major currency pairs as well as the price of gold. All right. Okay, now let's see where the next major resistance levels are. Okay, so let's look. We'll start off on the daily time frame, right? Maybe this we'll do it on a weekly first because this level does looks to be a bit cleaner. Right, I'll set this as second resistance. I'll explain to you why I would use this as a second resistance. Right, so we can see price making a swing high here back on 11th of July 2022 and then finding support here again in mid-September 2022. So we see a pretty strong overlap support here, which was finally broken. So now this is going to potentially act as a major resistance level, which is 108.08. I'm setting this as a second resistance because as we zoom in into the lower time frame, we then be able to see why that's so, or rather why that is the case. Right, and we can also use a Fibonacci retracement tool starting from the swing low here, going up to the swing high here. Right, we can see, oops, we can see, yep, you can see that, let me get the trend line. Trend line is not so clear. Yep, this is a little bit clearer. You can see the trend line has captured the market structure very well. So this is how you can use a nice Fibonacci retracement. Right, this is on the weekly chart. All right, so now let's zoom in onto the daily chart and try and see where the other resistance levels are. All right, okay, if you look on the daily chart, we can see price making a swing high resistance here as well, right, which is close to where the second resistance on the weekly time frame would be identified. Uh, because of that, maybe, right, okay, let's just keep it there. And then we can use this as the first resistance. And also the swing high that took place yesterday, we can use this as the intermediate resistance level. So this is how I would identify the resistance levels for the dollar index on the daily time frame, right? So you can see here of a combination of the weekly and daily time frame, right? Because on the weekly time frame, we saw 108.08 form a very significant swing high here. But maybe let's just stick to the daily and try and find something that's a bit, yeah, bit more better. Right. Okay. Right. Weekly. All right. I'm going to use this swing high here. Second resistance. So 107.99. So let's just use the daily time frame as a reference plane and 107.43 as the first resistance. Right. You can see the first resistance level, first Fibonacci retracement level here, 23.6%, lines up pretty well with this swing high that took place on 7th of March, as well as this swing high here on 6th of Jan. So you can see that this level here is a pretty decent support level as well. Let's see, I'm going to just put this as the first support for now. Then if we see any other level, right? Okay, so this is just for the daily time frame. How we can use the Fibonacci retracement tool, as well as looking for significant swing high resistances to identify potential resistance levels as well as potential support levels too. All right, let's go into now the 4-hour time frame and try to identify if there are any other more actionable levels around. Okay, right. Okay, I think I do see an intermediate support level here. Right, this is a pretty decent intermediate support level to identify, which is at 106.83. We can see price making a swing high here on 27th of September. And then after price broke above this level, it did find support here on Tuesday. But now it seems to be falling towards this level and it could potentially test this level here at 106.83. All right, I think these are the more actionable levels that we can use for the 4-hour time frame for the dollar index. All right, so we're just going to zoom in a little bit so that it's a bit clearer. All right, so intermediate support for the dollar index now on the 4-hour time frame. We are looking at 106.83 as the intermediate support, with the first major support coming in at 105.70. First resistance is the swing high that took place yesterday, which is at 107.38. And the second resistance is at 107.99. Right. This is and we've also used the Fibonacci retracement on this big bullish move as well. And we're using 23.6% to help us add significance to this major overlap or this major pullback support here at 105.70. All right, so this is the main uh, resistance and support levels for the dollar index on the 4-hour time frame for today. Let's just look at now. Let's just switch over to the euro. So with the euro falling very sharply, right, over the last 12 weeks, you can also do a Fibonacci retracement starting from this swing high here, going down to yesterday's swing low. Let's pull up all the Fibonacci levels. and try and find potential resistance and support levels. All right. I think in terms of support, this recent swing low here would act as a pretty decent intermediate support. And we do see a nice overlap level here, pretty decent overlap level here, where price ran into resistance on 3rd of, yesterday, 3rd of October, and is testing this level as well once more today. So this is another good level at 1.0487 to identify as an intermediate resistance. What about the first major resistance level for the euro? We do see price making a swing high, very significant swing low bounce here on 31st of May. You can use this level to identify as the first major resistance. We can see a significant swing low bounce here taking place on 31st of May, another bounce here on 15th of September. And we can argue that price somewhat found support roughly around this level as well towards the end of September. So once price has broken through this level, this now is going to act as a potential major resistance. So intermediate resistance for the euro is at 1.0483. First major resistance, I would probably highlight it as a zone between between 1.0610 and 1.0635. All right, so this is how we identify the first major resistance. What about the first support? There seems to be no bottom in sight for the euro. Well, okay, if we do see, if I do stretch this level out, if I do zoom out a little bit, we can see price making a pretty finding support here. So I think this would be the first. I think we can use this level as the first major support. Let's come back to see where price is currently trading. Yep. So we can use 1.0434 as the first major support, major pullback support for the euro, with 1.0448 as the intermediate support. And if anything else below that, let's just zoom in. Probably this level around here would be the next, where price has bounced off 1.0315 to go higher back in November of 2022. This would be potentially the next major support level for the euro, right? Is there anything else we can use? All right, okay, we can also see that the first resistance level lines up pretty well with the 23.6% Fibonacci retracement level. That's fine. And then the 38.2% also lines up very well with a nice overlap level here. So I think we can use this as use this level to identify the second resistance level. So we'll use 23 and 38.2% Fibonacci retracements to help us identify the first and second resistance levels. All right, okay. So just to recap, oh, I don't need 50. That's fine. Let's remove 50. Second resistance level is this overlap level at 1.0765, which also aligns with the 38.2% Fibonacci retracement level. First resistance level at 1.0635 is also another nice overlap level here, or a pullback level here, that aligns with the 23.6% Fibonacci retracement level. We have an intermediate resistance level at 1.0487. We have an intermediate support level at 1.0448. First major support for the euro is going to come in here at this swing low here back in December, which is at 1.0434. And the second support is at this swing low back in November at 1.0315. Okay, what else can we do? All right. Okay, so these, okay, I think these are the main levels that we can identify for today. All right, there's a question. Gold. All right, yeah, sure. We're going to cover gold as well. Right, we can cover gold. Let's go to gold after this. And then we'll proceed on with the rest of the majors should there be time. All right, so let's look at gold. Right, gold as well has been in pretty much of free fall. It's been pretty hard to find a significant support, but we can see the next major support for gold seems to be coming in around 18,010. Right, that's where the next major support for gold seems to be coming in. So yeah, all right. So 1,806 is the first major support for gold, and if you see any other major significant levels, okay, let's just see where price is currently trading. And I think this swing low that took place yesterday, we can use that as an intermediate support level. All right, and then we can also use a Fibonacci retracement. Let's start this retracement from this swing high here, 20th September, going down to the swing low, 3rd October. Let's pull up all the fibs. Right, any other? Oh, there's no other major levels that we can see. So I think in terms of intermediate resistance, we can see that yesterday's swing high could be at 18,033. You can use that to identify an intermediate resistance level. And the next major, I guess you can argue the next major resistance level is probably around here at 1,872, which is pretty far off. We see a pretty decent overlap level here, which lies slightly above the 30 or lies close to the 50% or is right smack in the middle between the 38 and 50% Fibonacci retracement level. Right, okay. So that's how we've identified the first resistance, major resistance for for gold. We'll just keep 38 and 50%. And okay. Yeah, so as you mentioned, with dollar being so strong over the last 12 weeks, gold has been pretty much in free fall, but that's it. We can expect retracements higher, right? There's always pullbacks to the upside that can take place, especially if today's ADP data comes in softer than expected. So if ADP data today comes in much lower than the forecast, this could potentially act as a bearish catalyst for the dollar index, and hence that could provide some much needed lift to gold prices today. So that's how today's data could potentially have a major impact on gold prices today. But of course, if the data comes in stronger than expected, then we are likely to see gold prices fall even lower. Okay, what else can we do for gold? Because there's not much there's no real other level. Yeah. So you can see since September 20th, since last week, it's been pretty much in a free fall, right? We can't really identify any significant overlaps or pullback levels as well. It's been pretty hard to find or to identify major support levels for gold, and the next one is at 1,806.40. Okay, intermediate support at 1,815, intermediate resistance at 1,833, and first major resistance, which lies between 38 and 50% Fibonacci retracement level, which is at 1,872. All right. Since we're on gold, let's just cover oil as well. Move on from one commodity to the other. So you can see here, after hitting a high of 95 dollars and 40 cents per barrel, oil prices have been retreating pretty sharply as well, but we do see a strong overlap support here, right? So I think this is where we can identify the first major support for oil. The first support for oil is at 88.14. We can see price running into resistance here in early September, and then once price broke above it, it found a little bit of support here on 13th of September. And I guess you can argue here on 26 September, it found support above this level again. And of course, on Tuesday, yesterday, it found major support here to retrace slightly higher, and it looks to test this level again. So that's how we've identified the first major support for oil. The next support level for oil could be this, yes, this overlap level here at 86.21. We can see price running into resistance on 4th, 5th September. And then after that, finding support on 6th September and 8th September as well. So that's how we've identified the second support for US oil, which USO, USD, which tracks WTI futures. Right. I think we can also do a Fibonacci retracement here from this swing high 27 September going down to the swing low here, 3rd October. Let's pull up all the fibs. Right, we can see where price ran into resistance yesterday at 23.6%. We can use this 23.6% to help us identify an intermediate resistance level for crude prices. And we can see a pretty decent pullback support here at 38.2%. So I think we'll use that as the first major resistance level. And the second resistance level lines up. It's a nice overlap where the 50% Fibonacci retracement level is as well. Okay, we'll get rid of all the Fibonacci levels. We'll just keep 23, 38, and 50. Right, okay. So let's just zoom in a little bit here. Okay, so you can see how we've identified the major support and resistance levels via a combination of identifying significant overlap levels as well as using the Fibonacci retracements to help us identify the significant levels as well. Okay, for the second resistance, I can pull it back to here as well. We see a nice overlap as well. You can see price running into resistance here on 22nd September, then finding support 28th September, and then running into resistance again on 2nd October. Right. What else can we do? Is there any other? If I use a Fibonacci retracement from this, does it capture the market structure pretty well? Yeah, this part here, it actually just doesn't capture this part of the leg where it captures this part pretty well, but after that, once price broke sideways, the trend line obviously doesn't capture this part of the market structure well. So I think we won't use the Fibonacci retracement for this leg of the move. Let's see where else can we identify. I think we use the Fibonacci retracement here from 26 September up to 27 September. We can try and use the extension levels to help us identify potential support levels as well. So, right, we can see the 127.2% Fibonacci extension level aligns quite close to where the second support had been earlier identified. So this is a pretty good, decent resistance zone for US oil. All right. Okay, so this is okay. So these are the key resistance and support levels for USO USD, which tracks WTI oil futures. Right. Okay. Any other questions? All right. Okay. If not, then let's go to dollar yen. Right. This intervention, this suspected intervention has really had a big impact on the yen crosses as well as this major pair here. Right. Okay. So if we use, let's see, let's look at a daily time frame and see if we can identify. Does it capture the market structure? It's okay. It's pretty all right. I think it does offer a pretty decent level here. Okay, I think it does capture the market structure quite well. It does capture the market structure quite well. So I think that's fine. I think we can see here price making a swing high here on 22nd of October. That's how we've identified the first resistance level, right? I think that's pretty clear. Second resistance, we can, okay, as you can see, dollar yen is making about, I think if I'm not mistaken, if we look at the monthly chart, it's making like a 30-year high. The last time prices dollar yen hit 150 was I think back in early 1990s or late 1990s. I think first resistance is here. I think second resistance will just simply take it as the top of the wick here. Now, what about support? We do see, is there any nice, oh, okay, we do see a pretty decent overlap level here, close to where the 23.6% Fibonacci retracement level lies. We see a pretty decent overlap level here. We can use that to identify the first support. Right, and the second support would be closer to where the swing high took place here on 30th of June, and we can see price finding support here in August as well, which also lines up close to where the 38.2% Fibonacci retracement level lies. So we'll use 23 and 38.6%. Right. Okay. So that's on the daily time frame, right? We have identified the major resistance and support levels. Now let's dive into the 4-hour time frame and see if we can identify any other actionable levels as well. All right. Okay. I think we do see an intermediate support level here. I guess you can argue that this level here at 148.45 could be potential intermediate support level here, right? Price ran into resistance on 20th September and then on 29th September last week. Price bouncing off this level again, and of course with yesterday's intervention measure, it broke through here. So we do see a pretty decent case to identify 148.45 as an intermediate support level for the dollar yen. All right. Okay. So just to recap. All right. So just to recap. So for the 4-hour time frame for dollar yen, second resistance at 151.94, first resistance at 150.28, intermediate support at 148.45, first major overlap support at 146.40, and second major overlap support at 144.89. And the support levels do tend to line up quite close to where the 23 and 38.6% Fibonacci retracement levels lie as well. All right. We can then look at, okay, let's look at the Kiwi since we had a big announcement today. Right, let's see where the immediate support and resistance levels. We use the Fibonacci retracement here. Right, we can use the price made this high. You can see this price making a pullback resistance here, which lies close to 23.6%. I think that's fine. We can use that. And we can also see a pretty decent overlap or pullback support level here at 61%. So we'll use the 31 and the 61 point, and sorry, we'll use the 20. We'll use the 23 and 61% Fibonacci retracement levels to help us identify immediate resistance levels. Right, and I think for the first support, we can see price making a swing lows or pullback support here in early September. So that's how we've identified the first support level. What about the second support? Are there any other major pullbacks or swing? Right, the next one does seem to be here. You can see price making a very significant swing bounce here back in November of last year. So we can use this to identify the second support. All right. Okay, so these are the resistance and support levels for the Kiwi on the 4-hour time frame. Second resistance at 59.85, which is a pullback resistance that aligns close to the 61.8% Fibonacci retracement level. We have the first resistance at 59.20, which is a pullback resistance level that aligns close to the 23.6% Fibonacci retracement. First support is this pullback level here at 58.59. where price found decent support in early September. And the second support is at 58.45, which is the swing low support that took place in November of last year. All right, so that's what we have for the Kiwi. Okay, oops. Now let's just cover the Aussie as well. Its neighbor. As you can see, the market structure or the price structure for the Kiwi and the Aussie is pretty similar, right? So let's just quickly try and identify the major support and resistance levels for this pair. Right, okay. Similarly, there's no, okay. I think this would be, this would probably be a good level to identify as the second support for the Aussie. Right, 62.77 is a good, you can see price making a very significant swing low bounce here, right? Making a very significant swing low here, bouncing very high off this level. So 62.77 is a major swing low support. It is be using that as the second. Actually, we should use that as the first support because it's very close to where price is currently trading. And I would use this recent swing low here that took place yesterday as an intermediate support. Right. Okay. So intermediate support is at 62.85, and the first major support is that swing low that we saw, which is at 62.77. Now, what about the resistance levels? I think the first major resistance level for the Aussie is around where the 23.6% Fibonacci retracement level lies. We can see price bouncing off this level here back in 27th of September. And after breaking through it, it does seem to be finding a little bit of resistance close to 63.31. So that's how we've identified the first resistance level. Now, what about the second resistance level? I think there's not much to work with because market structure is not very good. But okay, if we zoom out a little bit, we do see this level here at 63.64, price finding support here on 17th of August, and then once again on 5th September. This could then now potentially act as a second resistance level. This might be closer to where the 38.2% level lies. Let's just adjust this. Yep, it's pretty close to where the 38.2% Fibonacci retracement level lies. All right, okay, so let's just recap for the Aussie. Okay, we don't need 61. Let's just tidy things up a bit. All right, okay, just to recap for the Aussie, second resistance is at 63.64, which is this pullback resistance here that aligns close to the 38.2% Fibonacci retracement level. First resistance is this pullback resistance again at 63.31, which aligns close to the 23.6% Fibonacci retracement level. Intermediate support is at 62.85, which is the recent swing low that took place yesterday. And the first major support is at 62.77, which is the swing low, a major swing low that took place back in November of last year. All right, okay, so we've come to the end of today's webinar. So as I mentioned, do take note of the ADP non-farm payroll that's coming up. Employment change is coming up later today, 12:15 p.m. GMT time. That is definitely going to impact the value of the US dollar, and hence dollar index is going to react accordingly, and naturally gold prices and all the majors will trade accordingly. All right. Thank you everyone for tuning in today. I hope this has been a great session. Do look out for all upcoming future webinars by Vantage, and I look forward to seeing all of you, and have a good luck trading. Have a good trading week. All right. Thank you, everyone.